Good morning, ladies and gentlemen. This is Clueless Day Trading Frank. Day after the Fed meeting, Thursday, July, June 16th, 2016. Let me quickly run over a couple of very important and critical factors that are driving the market, which I've been consistently pointing out to traders, so they can manage their trades better and react instinctively, and retain their flexibility in adapting to changing market conditions. What happened yesterday, is not uncommon. We have seen reversals on Fed days of an unprecedented nature going all the way back to 2014. The fake outs that we saw in pushing the markets higher, despite faltering technicals, as I kept on showing, uh, fooled a lot of traders. It even fooled me a bit. But I reacted instinctively, put out the puts out there as a hedge, and they exploded in value. I believe they were up in the case of the lottos, which were expiring yesterday, that dropped from the 2085 or so on the S&P down to the lows of the day at the close, generated in excess of 500 to 600% on the money. The overnight puts are going to work out too, as we will be selling them at the open at around the E-minis 2050 or so. Again, don't look at a gift horse in the mouth. Remember a simple theory in life. And in a second, I'm going to go over this chart and explain a little bit of the drama that happened yesterday. Remember something in life, and it's really a simple rule. When it gets too easy to short the market every single day and make money, you know something's different going to happen. It doesn't mean a trend change, but it means, as we have seen repeatedly in week after week, that when the shorts get too comfortable, the market goes the other way. Now, we have had global dysfunction here in the form of the bank yen strengthening versus the US dollar in a massive way. We have had the British pound coming down, all kinds of stuff going on, right? Our Fed meeting, which I want to touch on in a quick second. So let me just show you quickly what happened yesterday so you guys understand. Now, one thing I want to remind everyone, and everyone needs to appreciate that, and this is not, we're all big boys and girls here, okay? So we're not fishing for compliments, and this is not the type of service, which is basically, oh, yeah, he's a genius type of stuff, okay? Nobody's a genius in this market. You just have to be smarter, quicker, braver, and react and study and understand more, but not just study and understand, as I said yesterday, but to act on it. Oscar Wilde, I believe, once said, there are way too many educated derelicts in this world. Extremely, extremely professional and educated, maybe with like 6 degrees, okay, educational degrees and stuff, make the worst traders. Traders that generally are built out of, cut out of a cloth that has gone through the ringer many, many times. The more experiences you have, the more bad experiences you have with the market, the better of a trader you are in the long run. And that's just the way it is. Okay, whether you like it or not. So if you think if you're going to do this successfully and make some serious money, you won't be able to do it. Just this is not a walk in the park. You really have to feel the pain, take it, turn it into transformational positive energy, and always tell yourself that you can make it big. And I'm not Tony Robbins, and I'm not giving you some infomercial at 2 in the morning. I'm telling you the truth. That's just the way it is. Losses, it feels crappy. It's just like, my God, I can never do this. You turn around, and you stay persistent. It's not how many times you get knocked down in a boxing match, right? It's how many times you get up and fight is what matters. It's not how many knockout punches. It's how many times you get off the floor on the count. All right? So just remember that. Now, what happened yesterday wasn't, I mean, everyone's going to say, oh, it's so dramatic, this and that. It's not. First of all, if you listen to Janet Yellen carefully, and I certainly did, she's concerned. She's concerned about what's happening beyond our controls in the UK with the Brexit fear. And then what's happening in Japan? Japan almost went negative, not close to negative yield. Germany going into negative yield. So it doesn't matter what our central bank does. Okay, our economic numbers overall are holding up nicely, but we are globally interconnected. So if you listen to it carefully, the market should have been down 100 points like right off the bat. But no, it turned around, it held around there, and it just kept on. This was yesterday. So let me show this. Let me show this from the close of Tuesday. Okay, so and again, you shouldn't be looking at this for the first time because you have your own screens, right? So and I've been putting enough charts out there to run the whole storyline so you can read bedtime stories to your kids and they'll probably understand the market better than all of us. So anyway, so they held the market up, moved it around, and then here was this what we call naked top, spinning top naked bar. Now what it is basically a bar like this. It's an inverted candle, inverted hammer. You got a long tail. Okay, you have a long tail there. You have a long tail and the hammer at the bottom, right? Looks like a mallet, right? So once you get this type of signal, and I showed this much clearer on the using the algo HFT charts. I even put it out there, wrote it out there so people can see it. Once you see this type of pattern, um, it generally means the market's going to come down. Okay, at least for the day, or maybe continue a little bit into the next day. Now what happened? Market came down and then it started to rally. And this is what machines do. So get used to the fact that what you think is going to be a linear move or a binary move is probably happen, but it's going to happen after they throw you off the boat. So here's your inverted, here's your spinning top naked bar, certainly negative. I bought puts. My puts, as the market climbed on those three candles going into 315, my puts were down. I think they were down 30%. I kept on adding. I kept on adding because I believed in my work. Simple. And I was looking at a bunch of things, not just that, right? So kept on doing that, and then comes 330, bang. Now, what prompted that? Was there a news factor or anything? No, that's just the way markets work. They basically do not want you to be in the trade. And when I say they, I mean the fast-moving, algorithmic, high-frequency trading black boxes. Now, did they know that this was going to happen? Who knows? Maybe they did, maybe they didn't. Somebody out there knew. So my job, and this is why you pay me that puny little amount every single month, okay? On fantastic trade alerts and commentary analysis so you become a more educated trader and help yourself make money, is that I read in between the signs. And there's a lot of gut feeling involved, as in having experience with the markets. Now, did I expect this market to drop and go that negative that fast? No, but who cares? Preparation and guts and knowledge equals luck. So believe in that. So the bottom line is you get this big thing here. So all these average costing down and bang. The dollar lottos, which I bought, which were recommended, the SPX expiring yesterday, they went to $7. Okay. I actually sold a bunch of them here and kept a few of them. But I then looped around, if you remember, and I bought the June 17th, which was Friday's ones, which should be doing very well at the open. Did well at the close too. So the bottom line is that when you get these type of heavy volatility driven markets, and you could see that everything was chop, 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 it's just moving on the screen like, but going nowhere. That's where technical reading comes in at its best form. Okay. So, and you have to rely on me for that. Now, if you want to learn more, like I keep on saying, join the advanced coaching sessions. This weekend session is definitively going to be critical. And I'll certainly be making time away from my family to do this for you guys. And I think the ones who haven't signed up, sign up. Because aside from these video cats and stuff, all the deep technicals can only be taught during the advanced coaching sessions, which is on the members area, if you wish to sign up. Saying all that, let's take a look at the daily. Here's your daily chart of the E-minis. You can clearly see here that in nowhere form that this is an uptrend. This uptrend looks broken for now. Now, broken doesn't mean we're going to be down 300 points today. Broken simply means, and I've shown this on the charts posted, that we will most probably test some critical levels at some point before Brexit, and that would be the 2020 level. It could happen during Brexit. This is a critical number. Remember, add 5 or 6 points to the E-minis to arrive at S&P points. So 2020 E-minis, yes, would be 2026 or so on the S&P 500. So this is a major floor. Okay, this is a major floor. If we break this floor, we got some nice downside coming. We'll test 2000, all kinds of stuff. Now, we are deeply, deeply oversold on a technical basis. I want to talk about the technicalities of what's going on. And we are also creating what I call a falling wedge. Now, a falling wedge breaks up. Now, will the falling wedge just immediately start doing that today? I don't know. We'll see. We could slip and slide a little bit more, and then it might break out, and we head back towards that 2085 level that we touched yesterday. However, it could start here, or it could start here. I'm sorry, it could start right at the bottom of this. And I drew the falling wedge out, so I should take these drawings out so you guys can all. And I've put here. Remember something here. Everything that I'm teaching and stuff, that I'm talking on this video cast, I have those out in charts for all your review. So you guys have to open your eyes and take a look at them. Look, I mean, I know sometimes I get a little bit tough and I get into people's faces, trying to thing. And I hear some members, good members, saying, "Hey, I'm here to learn." Well, learn. Learning is not easy business. All right. So everything that I put out there is like it's a phenomenal service, Clueless A Trading, because you're getting an online in my opinion, $100,000 financial education on a real-time basis while the markets are on. Can't beat that anywhere. Go tell your buddies that. Go tell your brain that. We teach behavioral game theory, which is behavioral finance, conquering your fear by understanding what the markets do, technical analysis in its deepest contrarian form, and of course the constant trade alerts and charts. So can't get any better than that. Okay. So bottom line is that here is the falling wedge right there, already drawn. This could start here. I'm trying to finesse this a little bit. So it could be either starting off right here today, or it could slip and slide. In my opinion, it probably slides a little bit because don't forget, we have some tremendous amount of margin calls that need to be satisfied. Okay? Maybe that's why we get this capitulation in volume. Also, day count. Generally on the 6th day, or at least on the 7th day, the market has a relief rally. Don't forget, tomorrow's quad witching, quadruple witching, options expiration, monthly options expiration. So going too heavy short into that might basically blast you out. Because at this point, not just the majority, but even people like us who are tactically bullish and tactically bearish are feeling negative on the markets given the technical structure in the background. So let's look at this here. Stochastics in deep oversold territory, but still pointing down. This I would really like to see, like we were before we had that rally yesterday, at down towards the minus 200. I'd love to see minus 200 beyond that on the McClellan oscillators to get some sort of tradable bottom. Okay. The weekly charts and stuff right now are starting. This is the daily chart, right? So again, you see what I'm talking about. We hold the bottom of the Darvis, which is around 2056 or so, 2057 on the S&P 500. We bounced off the Darvis. Let me just hide all the drawings, okay? So I use the Darvis box as a point of reference. So if you look at it, we came to the bottom of the Darvis and at 2052 overnight, and then we are, we're starting to bounce a little bit. Can't see that because that's still an ugly candle. So if I draw a simple line, as in the form of a falling wedge, let me see where it intersects. It intersects around 2050. a number that's been bandied around, and apparently there's a lot of short interest on that side too. So 2050 S&P is where I think we land up by the end of today, if not by tomorrow morning, before we have a powerful 50 to 100 point rally. That's it. But as you can clearly see here, it's pointing down to go there. Now, if you have large profits and you say, well, Frank showed me this fantastic chart, I'm going to hold through it and it doesn't go that way, don't look at me. Look at yourself and proceed to slap yourself. If you have large profits, take it. Put some roll over your contracts. Don't go into very serious contracts beyond Wednesday. Or I'm talking about the indices, SPX specifically. Don't go beyond next Wednesday, because if Brexit doesn't happen, we're going to have a 400 point rally just like that. We're going to get straight back to 18,000. All right. So just keep that in mind. So that's it. Show you quickly about the weekly, and I don't want to predicate too much, but here's your weekly chart, and you can see here that the weekly chart is also starting to move quickly towards the oversold level. Now, when markets get oversold on a weekly level, you get fantastic tradable bounce. We played it every single time. Okay, while the rest of the world and all your other trading services, most of them, I should say, and the forums, basically just, oh, this is the end of it. This is the end of it. We were basically looking at these simple, deep oversold conditions, whether it be in 2015, whether it be in 2016. We played it. All right. So if we get down to these levels here, it's really as simple as that. Okay. Which means that we would test around the 2000, probably slip down a little bit. Because remember, these lines are still they still haven't curled down. When they start curling down and crossing over each other in a hurry, that's when you know we're start of a next 3 months of complete pain and suffering. But none of that is happening on a weekly basis yet. Okay. The lines are still kind of moving sideways. This is the 50 and the 34. They're getting dangerously close to turning, but I'm not going to go that far. So the bottom line is that if we come close, let's say we drop another 300 points, we'll get deeply oversold, and you should see a sizable bounce. Now, another thing that I want to point out to you, and I don't want to waste too much time here, spend too much time here, is when you hit these lines, they don't yes, they sometimes immediately bounce, but if certain things are weaker on many other technicals, they might just fall below that. The standard deviation from the lows of January away, standard deviation, the distance from the moving averages, was almost minus 9. Okay, no, this one was minus 9. I remember that. Okay, this one was minus 9, and so this one was like that too. Here, this was the minus 9 part. So what did the market do? The market moved up, hit it, and kept on going. Now, if you look at this simplistically, all right, simple things. I'm going to show you some tricks of the trade. How about that? Is if you look at this distance traveled, okay, take a little ruler, measure it. On a perfect world, then that's the distance that should be traveled here. That would bring us to somewhere around 2150. Yeah, somewhere around 2150 or 2160 on the S&P. But in the meantime, the market did this and now is pulling back. So when you look at the weekly, there's not much damage done. What I'm getting at, that you could very well have a reversal rally possibly in July or after the Brexit thing is done with. Okay, which would be as powerful a bounce, which measures on a measured move would be the same standard deviation measurement that we fell that we were down by, right? Oh, and up here. So if this was a standard deviation of moving back here of -8, so this move up was a +8, right? It took it back. So is it possible that we overshoot +8? I think that's a bit of a stretch, but we can overshoot on the standard deviation part by +4. That would bring us somewhere around the 2150, 2160 level. Is it possible? Trust me, if Brexit gets out of the way, there's going to be such a surge of money coming back into the markets, you won't believe your head. And stick to the power stocks. I guide people really well in so many different things. Don't get overtly bearish. Short term, we might be creating a tradable bottom between now